Right, good morning everyone. I'm Andy Ward of PwC. I'm on the IRLA board and very pleased to be hosting today's breakfast briefing. Before we kick off, just a few housekeeping points. If you could have your phones to silent please, that would be appreciated. Loos are outside on the left hand side of the corridor, and I am told if there is a fire alarm it will be real, but the staff here will all guide you out of the building. Great breakfast briefing today. I think it's really good to see so many people here. Insurance-linked securities just massively topical at the moment. I think we've been talking for a long time about how the capital markets and runoff will come together. So I'm really interested to and delighted that James McPherson of Barrios Partners is here today to talk to us about IRLA and its role in runoff. Just a little bit about James before I let him loose. James is a co-founder of Barrios Partners. He was a partner at PwC for 10 years and has been a qualified actuary for 20-some years now. He assists insurers and reinsurers with reserving, pricing, capital efficiency and M&A. And at PwC he led the London market actuarial practice. James is quite the entrepreneur. I didn't know this until today. With his wife, James co-founded Netizen Limited in 1994, well before most people had heard of the internet, and he developed this into a successful travel company, internet company, employing 21 people, and exited with a sale in 2007. James has a long history in the industry. He was at Travellers, previously St. Paul, and he's director of the Lloyd's Managing Agency, which grew from more than 100 million of premium to over $1 billion in 7 years. So a great CV. James has started Barrios. Very keen to hear all about it. James, over to you.
Thanks, Andy. Well, it's good to see a number of familiar faces. So hi to those, and for those who don't know me, it's James McPherson, and started Barrios, the sort of key one I did a year ago. And interestingly, moved from PwC, where effectively we could do anything, because there was 140,000 people around the world, there was nearly no problem that we couldn't solve, to Barrios, where we just basically have one product, which is the IRLA. So I am quite passionate about this, and we have 6 partners that work with me. I'm very happy to talk in detail about that. But I wanted to talk about how I see IRLA and how I see it may work well effectively in the runoff industry, and why I think there's another phase of IRLA coming forward. I'm conscious when we've spoken to people before, there's usually sort of a mix of knowledge, and the IRLA in itself is actually a very small group of people that actually work in IRLA, even smaller than the runoff industry, which is quite a closed community, or quite a small community that get on very well. IRLA is even smaller, and so actually there are quite a few phrases that I've probably been converted and just sort of throw out there. So feel free to interact and say, can you just say what that means, and ask questions as you go along. And also, they asked about Mike, and I said no mic. Can you hear me at the back, Mark? Are you okay? Fine? Yeah, fine. Yeah. Great, perfect. So over the last year, actually, we've been very lucky, and which is nice, in that the markets for bonds. So we had a view on what investors would want in terms of bonds, but we've spoken to them. It's slightly different. But people are desperate for yield out there. They're absolutely desperate for yield. And it's government policy to make people desperate for yield. Quantitative easing fundamentally is about buying up bonds and putting cash into the market. So removing bonds from people who want bonds and giving them cash, so they've got to go and try and do something with it. That's a policy, and hopefully that they will invest the cash somewhere else to help growth, and that would work. But there is over 300 years of the bond market, even more. There's never been a time like this. So this is an amazing opportunity in this market. To give an example of that, Allianz put a bond out there, 0 coupon. Basically. So there's no cost in terms of issuing that bond. And investors actually conclude that it's better than putting it in the bank, where you're going to get nothing and there's a risk because banks will fail. So actually they think that's a reasonable deal for 0. Yesterday even, Austria put a bond out there, 70-year bond, 1.5%. Austria hasn't been going 70 years. So it's quite a remarkable market, and so that actually means that if you've got an interesting product, you can put it out there for very little cost, and there's a huge amount of appetite for it. And my understanding of the runoff industry, much like the insurance industry, there's quite a lot of interesting things happening, quite a few deals, but the margins are being squeezed. So the costs have to be cut, and the cost of capital is the biggest cost. And so if you can cut your costs, if this is the cheapest market it's ever been, probably of all the choices in the market, the issuing a bond is the best thing to do. Not so sure I'll be recommending that anyone in the room buys these bonds in terms of you can buy ours, which will be good for a reasonable yield, but some of the other bonds out there, Allianz 0%, I don't know, it's not one for me. But, So a few things just about IRLA for those that don't know. So what is the state of the industry? And really these sort of came about, so started off early 90s and then took quite a while to really take off, and then more recently taken on quite a bit. And they're beginning to stagnate again as they're running out of liabilities to feed into it. But let's just go through a few of these. So you've probably heard catastrophe bonds in the non-life industry are absolutely bog standard. So this fundamentally went down to North America windstorm. There is sufficient liabilities for a big hurricane hitting Florida, North Carolina, etc., that they couldn't place it all in the reinsurance industry. So basically there was a shortage of capacity, and that's really helped bonds being put out there. And they're a one-off shot. You put it out for a year, and you get your money. If you're an investor, you get your money back if there isn't a large enough hurricane, and if there isn't too big a hurricane, you lose your money. But that's a risk you take. You can model it, you can assess it, and it diversifies well from your portfolio. So very standard, most people do understand those. I chucked in insurance industry loss warranties, some ILWs, people muddle them up a little bit, but industry loss warranty technically refers to a trigger point that is whether a hurricane is, let's say, over 10 billion. So instead of it being an indemnity trigger, which looks at if you insured something like Allianz again, Allianz property cat portfolio around the world, if they lose over 1 billion on one event, then that would be an indemnity trigger that the bondholders wouldn't get back. The industry started off more with sort of parametric triggers like industry loss warranty, where PCS would come up and say this hurricane is a 6 billion, so Hurricane Matthew is a 6 billion, it's over a certain amount, then it's a trigger, so it's 100% you lose all your money. If it's £1 under that trigger event, you lose nothing. And so you can buy and trade those very easily because there's no underlying portfolio you need to look at. Does that make sense? That's IRLA and ILW. Then collateralized reinsurance, sort of relatively newer, and really that is works very well for insurers because they have the reinsurance industry did consolidate quite a bit, so people do have a huge amount of exposure to the Munich region of Swiss Re's. So this is a way of moving some of their portfolio and the risk to a reinsurance company, collateralized, typically in Bermuda, and that's a segregated sale, and then you can fund that a number of different ways. It could be a sidecar, it could be a pension fund that wants access to insurance, and done different ways. So that's taken off and it's grown quite a bit. And the idea is being collateralized is that it's got typically there's one cell with one contract, again let's say it's Allianz, and then if it's a 100 million contract capped at 100 million, it would hold 100 million in cash sitting there in Bermuda to pay that contract if it flows. So it's very secure, it's nice to diversify. Then there's sidecars. They all sort of came into us. I think someone from Goldman Sachs invented them, and then once had the idea, ponded off to lots of people, which was good. Which was a similar using something like collateralized reinsurance, or some possibility that they would take. Let's say if you got a portfolio of 100 million, we'll take 25 million off that, and we'll put it offshore, and then effectively there'll be different capital backing that. So you're only taking 75% of the risk. We'll pay you a sort of override, or pay you some commission to bring in the business, but you can write more business, including some of the peak risks. And they have typically been property cat, maybe extended to a wider property. In theory, they could be used across anything. Once again, any questions on those four? Quick question: how interested are people in the life side? That's one nod and it's an emphatic nose. One nod there. So enough people. So sorry guys, if you can tune out for a bit. So the reserve funding securitization, sometimes called XXX, which isn't some sort of slightly dubious spam email you got. These were what happened. The Institute of Actuaries in casualty actuary society, I think, in the States, worked out that for the term assurance, so for people getting a benefit in the event they die, people weren't holding really enough reserves in their view, and so people would have to hold substantially more capital on top just in case of a pandemic. So it's extreme mortality. Too many people dying. We're used to the longevity one, which is too many people dying in a short period of time, and they suddenly said you need a lot more funding for it. And because the premium is very small compared to the amount that's insured, that was a very large sum. So, someone cleverly managed to, one of the solutions was again to put that out into the capital market. So the capital markets provide some of the protection for that in a XXX bond, and as long as there isn't a large number of people dying in a short period of time, they effectively get a premium and get their money back. Embedded value securitization is a bit more taking an entire portfolio of life contracts and securitizing amount. Extreme mortality securitization is similar to reserve funding. Reserve funding is a bit of a regulatory play. People are definitely tuning out to talk regulation, reserve and life combination. And then life settlement securitization in a similar way was a way of pooling some life portfolios and putting them out to the bond market. And then longevity swaps are a different type of thing altogether, which fundamentally says if you've got a portfolio of annuitants, so these are people that are being paid regularly for the rest of their life, you can basically swap those for a payment up to a certain period of time. So perhaps for someone who is 60, you can get a payment for 25 years only, and you swap that with an investment bank or someone else who then takes the mortality risk on that and pays whatever is required in terms of how long the person lives. If they live to 100, the investment bank loses. If they live to 75, the investment bank wins. But you know you converted your liability to being fixed. You're pleased to know that's about the end of the sort of specific teaching of IRLA and in a wider field. So I'm going to give you a bit more of a view from investors, which I thought I understood when I was in the insurance industry, but actually when we talked to investors, we didn't really understand them as well as we thought we did. So what do they think? First of all, insurance is actually a really good asset class at the moment. So if you're ever wondering about where to put your money or your company's money at the moment, it's very difficult to see what might be safe. And actually insurance is quite good because it's not really too impacted by economic downturn. People still worry that we might get another economic downturn like 2008. And in addition, when people look at their portfolios, when they have a huge portfolio, 200 billion or something, they're trying to see how does that weight compared to our exposure to the economy as a whole. When you look at the size of insurance's its contribution to GDP, it can vary by company, but 3, 4, 5% is not unreasonable. But people typically don't have as much exposure to that. So they look at their portfolio, GDP is about 3, 4% insurance, and yet their insurance portfolio maybe only have 0.5% exposure to insurance, even though it's quite a safe, good class to be linked into. So that's what this one says. A bit of the worldwide non-life insurance capital is nearly 2 billion. If you want to try 2 trillion, sorry, if you want to get some access to it, you can invest in listed non-life insurance companies, but that's only 500 billion. Subordinated debt is tiny. Catastrophe insurance linked securities is barely on the scale, and sidecars is barely on the scale. So there's very little way that you can get the full access. Some of that's there's mutuals, there's cooperatives, there's other ones that just don't go to the capital markets. And then the scatter graph on the right is to demonstrate that it's a scatter graph, which is really to do with insurance is quite a good uncorrelated asset. So if the rest of the economy goes, it doesn't necessarily mean that insurance will. So that was giving a bit of a view of that, comparing underwriting result with the S&P annual returns. So if you're investing in any general equities versus the underwriting result, there doesn't seem to be any correlation. So what? Surely this is all about the bond markets. Why should anyone really care about the bond markets? Well, with the insurance industry, and I would say probably the run-off industry is a bit more advanced. There's a bit more thinking about capital in a proper sense, rather than just the actuaries doing some numbers in the ivory towers and talking about capital. The entrepreneurs that buy the portfolios in the run-off sector think quite hard about capital level is a real number. They've got to go and raise it. They've got to get people to put the money up. And they're going to have to pay that back in a relatively short period of time, perhaps. But for mid-size and large, I think 99% of normal insurers are just equity funded. So pretty much all of their funding comes from equity, and we think that's a bit crazy. And so the larger firms have begun to put more subordinated debt and some other funding mechanisms in place, but a relatively small amount. What we see is the future is pretty much how most industries goes when they get competitive, and what you see in the banking industry, in that you have the more levers you've got to play with. And again, my understanding on the runoff is that it's typically equity with reinsurers playing a very important part of the capitalisation, but that's only 2 levers. So if IRLS could be got to work in the runoff sector, then you'd add a third lever, which you'd be able to issue bonds, which provide you with capital as well. So that you're going to have equity investors, you're going to have fixed income investors, and then you might have hedge funds take some of the risks, and the reinsurers will help that as well. So this chart is slightly confusing, so I'm going to take you through it in quite a way. This basically puts the costings out there. So I talked about Austria and I talked about Allianz, but they're sort of their debt, which is a bigger market. This is going to look at the IRLS market and some of the prices linked to that. And so what this chart here says is this is the maturity, so years to maturity. So most of them are multi-year, typically around 3 or 4 years in terms of if you're putting out your property catastrophe. And then here are the spreads. So they do it basis points from 500 means you're getting 5% more. Typically get sort of LIBOR plus 5%. And there you see some of the pricing you have. A lot around the 5%, a few much higher, 15% plus. And in terms of that one, that would have a pretty high probability that you might hit it. So it might be quite a relatively low property cap. And then this one splits it slightly different. This in terms of says for duration. In terms of insurance debt, so this is the Allianzes and other insurance companies that issue debt. It has a yield curve that you would have seen. So the longer the maturity, you get a higher yield. So 10-year is sort of 4%, and then it comes down 2 years or 4 years. You took 2.5%. They probably come down a little bit from there, but that gives you a bit of an idea of what the bonds are issued out into the market as, which gives you an idea of the appetite of investors. They're willing to take the debt at sort of 2.5%. Allianz we view is particularly safe because it's very diversified, but there's quite a wide range of insurers within that portfolio. Any questions? So I bet you there's one opportunity for run-off portfolios. So we're highlighting here the same one that the equity versus premium ratio actually has gone up. So we're concluding there's probably too much money already in the insurance industry, but the cost of the bonds has come down. So I wonder if you've got to cut your costs, you've got to cut your costs across the board. And one of the key ways of doing that is to issue bonds and get rid of some of your expensive debt. We'll talk about how that works most effectively a bit later. So we highlighted that mixture of equity and reinsurance funding. So when we've spoken to people about this, the way we see this working is it wouldn't be that we go to Allianz and say we'll look after your legacy and we'll do some IRLS on it. That doesn't make sense to us. If we go to Allianz, we'll say we want to cut your cost of capital, and they would say, okay, we need 3 billion to move the needle. It's a big company, and we want to cover everything. So we would aim to be covering everything and issuing bonds for the whole of Allianz, like they've done with subordinated debt, but ours have been insurance linked. However, if they were looking to sell their legacy book, then we are approached sometimes by the buyers, which conclude that they might be able to get their capital cheaper if they put some IRLS type structure in with their reinsurance as well as their equity, whoever is funding the buying portfolio, and hence they'll be a bit more competitive in that also. Is how we engage with the industry to date, but very interested to hear if other people have different ideas.
James, just on that point, I mean, putting a deal together like that, I mean, what's the regulator's view of IRLS as capital? Have you had conversations about that?
Yeah, so it was quite a strange conversation with the Bank of England. And it's the first time ever I went there, and they were very positive, and they were trying to. I assumed that this would be quite a difficult conversation, but genuinely they were. And it was just after George Osborne had said ILS needs to happen in the UK, because they have worked out that it's nearly all happening in Bermuda. And one of the key reasons for that is you can set something up in about 2 weeks, and if you know you're doing a deal, you can't have it that after 6 months, you know, the UK regulator might come back with that this might work or not. The deal's dead in that time. So to move quickly. Secondly, they have this idea of the cell where you can be fully collateralized. So if it's one contract of 100 million, and you've got 100 million sitting there to pay that one contract, you don't need a large amount of other capital or a large amount of regulation around that. That's a pretty straightforward structure. So the UK is committed to putting it into changing their regulation and adding in that type of technology to the UK, and maybe improving the tax of it as well to try and make it happen, but they haven't put that in yet. So sorry, have I answered that?
Yeah, thank you.
Sorry, James, just on that previous slide, when you're talking about the structure, are you sort of envisaging a sort of ADC layer that will be fully cash collateralized and be subject to negative liabilities where that cuts in will be dictated by sort of ILS appetite?
Did everyone get that? That's basically when it's 5 slides, but that's but if I'll give you that without do too much of a spoiler. Assuming that most of the risks would be the adverse development cover, effectively, how are you going to protect that? And the real arbitrage is that if you need, let's say, 100 million for the sake of this discussion, you need 100 million to protect it. So that's the capital, not the underlying assets versus liabilities on the best estimate basis. The 100 million. Then what you don't want to be doing for your capital is paying the same amount for the first 10 as you are the top 10. And the top 10 is very unlikely to be hit if everyone's got the numbers right. The regulators bid 100 million, then it's pretty close to a 1 in 200 if it's in the top 10, and it's probably pretty close to a sort of 1 in 10, 1 in 20 at the bottom 10, or even worse. So it's splitting that, and it's carving out some of that, and it's carving out some of the stuff at the top where you can actually say this is a 1% chance of it being hit. Then why shouldn't it cost me 2.5%, 3%? Why is it costing me 10% of its equity, or why the reinsurer is taking this amount? Does that answer your question? A lot of nods there. You might finish early. But actually size is worth discussing as well. So we say 100 million would be a minimum, because there is some cost to issuing these bonds. They're very good for investors because they're very standard. They can put them in a portfolio. They can, in theory, trade them if it takes off in the future. They can sell them. But there is more work to do to make them in that format that you can then put out into the markets. So then, breaking down that point, how you get there. So first of all, we work to independently verify the whole account underwriting risk profile of investors. So that if there was a portfolio that had been bought, or people were looking to buy, then you've got to have that exceedance curve. So if you're going to start slicing out your 100 million, you've got a pretty good idea of whether, when I said is it near to 1 in 200 at the top 10, is that right, or is it 1 in 50, or 1 in 300? So getting that sort of curve that regulators are requiring anyway is very important. So we have technology to do that very quickly, and that's what we do. We might involve other third parties, or companies typically have that as well. But that enables us to come up with a view of the cost, and how much we think is the risk, and then how much we think the bond markets might charge based on the current risk appetite they have. Property cap is all done on multiples of the risk, so it's a 1% chance of a loss that typically they would charge 2.5%. If people want to say it'd be 2.5 times the probability, and in a similar way, up the risk market's going to go the same way. And then we execute, and the execution, and this ties a bit to what the regulators say, is the traditional collateralized reinsurance arrangement. So to the underlying insurance company, it's all they see is collateralized reinsurance contract. There's nothing else they need to describe to their shareholders, investors, regulators, or in-house. The only thing they have to be interested in is how good is that collateral? Will it definitely respond? Is there any way people can get out of it? It's kind of a bog standard reinsurance arrangement to remove this risk of you can't add complexity into a regulatory environment around the world. It just takes you too long. So they've signed off, they've agreed quota shares in lots of different circumstances, and hence it is the mechanism most preferred, I think, by anyone who wants to take the liabilities and do something interesting. So I highlight again, there's the curve, we've worked out how much percentages, and we put the bonds around it. And then the trigger point, the point of where on this curve do you start? Where you start is if you want to be investment grade. So you heard about junk bonds, etc. aren't investment grade. If you can get triple B or A, which is near that sort of 1% point, that's where there is the huge amount of appetite. That's why they can get away the Austrian bonds. And even Saudi Arabia, they put out 10 to 15 billion. They've got 67 billion people chasing it. At the moment it's investment grade. You tap into a market that's 5, 6, 7, 8 times bigger than the equity markets. It's just huge. So that would be the aim that we would typically structure it to say how much of this can you say has a very low probability of return. So then in terms of the trancing, again we touched on this before, is that you basically take a slice and then you say how much can you say double A, how much is A, how much is double B, or it might just be the two. You want a couple of tranches that you split out. The underlying below that, is kept by the investors, by the principals, and that goes back to them. You could put that to a third party, hedge funds and others would be interested in it, but typically the returns are geared up to some extent. So if you're making 8% on the whole deal, and if you put some of this in the top, so that's funding some of the lower percentage, then obviously the 8% for the lower amount gets ramped up to 10, 11%, depending on how much. So typically we look for whole account reinsurance. Moral hazard, the investors worry a lot about it. We thought they'd be interested in models and how that works. They don't have a slightly different models. You just have to say the word model and they just basically think, well, you're a smart guy who knows about models. We don't. You're just going to comment with a model. So that they want to know things are done properly. They want to know someone's done it and they're independent and that model's unbiased. So that they want, some of the percentages, but they're looking at it a lot more for sort of moral hazard view. And that's probably why this hasn't really taken off as much in the past, in that if you have built a model with the sole purpose of putting away a bond to investors, the investors are understandably a tad sceptical of that. But because you're Solvency II, lots more people are required to produce these models. And there are people on the board that would like the model to have a thin tail, perhaps the CEO, and there's people who want to have a thick tail, perhaps the CRO and others, because you don't know if they go into that area and they get hit, even though they said it's very unlikely that isn't going to go down well with the regulators. So it's a much more balanced view, and that the regulators have to approve it and validate it first. And then Solvency II's changed the game on that. And that's both in Europe, but in addition, lots of other countries around the world are putting in regulation that's very similar to Solvency II, except America, of course, as they do things differently. But they're basically getting it via the rating agencies. They tend to look at the rating agencies, but the rating agencies are more and more looking at expecting firms to have their own capital. So a dedicated special purpose vehicle, form a quota share of reserve risk will flow into that for say a 5-year period. So you can lock in 5 years worth of the low bonds, and then we stack that. The first loss there is taken by the sponsor, and basically we're imagining it would sit side to side with a reinsurance rate. So you're just cutting out the amount you have to pay to the reinsurers to negotiate a slightly better price for them, cheaper. Because typically the higher layers are paid for by reinsurers in the public sector. People are buying it.
What happens after 5 years? So the quota share, the reserve risk flows into the SPV for a 5-year period. So if your portfolio is a 30, 40-year liability portfolio, what happens?
Well, that's quite a complicated answer, but simply think more debt. So it just disappears and it comes back to you. So you can actually say Admiral's business, so you're looking like, well, why does anyone accept that? But if you think, say, the Admiral's business model, which is, they have a return on equity around 50% every year, and they trade at 9 times book. And their model is basically that they have a quota share out, mostly to view the traditional way, but of 75% of their book. But they're utterly dependent upon that. So what they do is in year 2 or 3, they put a system in place for the capital for the post 5 years, so that they're never running more than 2 or 3 years with knowing that problem. So we're imagining that this market will be the same one. It's 5 years, but then it does end, but you have 2 or 3 years where you put something in place. Depending on the markets, could be another ILS, another 5-year bond ready in place, could be other reinsurance in place. It will be smaller because the runoff would have got smaller, but you've got choices of how you change the capital per 5 years, but you'd have to put it in.
So what happens after 5 years? The bond markets are transformed completely. Interest rates go up. Investors, want to go back to conventional bonds. What happens then?
You have a choice of how you can raise capital with it. We haven't. We thought people would balk at 5 years. Some of them have said that they would like longer. The investors. So it's not impossible you put longer, but you'd have to do. You might be able to do something whereby you kind of had an option. You don't. Basically, you've got 100 million. After 5 years, what's it going to be? 40. You don't want 100 at that point because you've hopefully had a successful bit of reducing your liability. So to some extent you need to recapitalize, but the nature of these bonds are that they are pretty fixed. So it's how you're going to do that and when you're going to do it. You could try and do it all up front, but fundamentally the simplest structure, it's 5 years. So you've got a cliff at the end of the 5, and it all comes back to you. So you're going to have to deal and manage with that.
James, linked to that, if you have got a long duration portfolio that wouldn't pay out, if you've got 100 million reserves, you could put in the money kind of structure in place that was 40x at 60, where the 60 wasn't expected to be paid in the first 5 years. Is that kind of an in the money equivalent type structure where this market would be interested in playing?
I'm just trying to, that is a slightly different structure. It's very interesting and might be a good structure. I haven't thought about. So this isn't really a payment timing issue. This is meant to be a real liability issue. So if you're taking a 40 over 60 in how we're describing, you put 40 out there, then it is about, we do it by what's put in the accounts at the end of the 5 years. So if you're into that and the future as well, then you would draw down on the bond. So I think you were discussing it would be more to do related to the payments. Is that right?
Yeah, I'm just saying, would they provide effectively an in-the-money agency which could start below the best estimate and also provide coverage above? But if it is in the money, we're not actually going to get paid because these guys aren't actually expecting them to have to pay anything out of the capital that they buy. So it's almost the same structure, except it kicks in and provides you capital below your best estimate, so it effectively gives you a net reserve reduction as well as a capital protection.
It's an interesting idea. When you get to investment grade, they're obsessed with getting their money back. That's all they care about. And simplicity is absolutely key. So you might be able to structure that in a way that you get. Is this some sort of discounting as well as someone that did it first there? If you give them the top bit, you might be able to do something as long as the bondholders get it such that it's a very unlikely event. So 99% of the time they get their money back, definitely, and that's held separately. Then they're fine about it. They almost don't care about the mechanism as long as there's some protection for them. So why now? I think I'm talking about investors and their appetite for yield, and particularly longer term underwriting exposure, and then the little or no correlation to other capital market risks. I would highlight again the economic risk is one. The second one is, I don't think anyone in the investment market, or probably anyone at all, has forgotten the 2008 liquidity crisis, and that was as much liquidity as anything else. So the banks were seizing up. And what that meant is that anyone who was in debt, and the only way they could repay that debt was issuing more debt. So they're coming to the end of the 5-year debt period, they're going to have to raise more debt. The view was that they might not be able to get that away. No banks were offering it, everyone closed up, liquidity closed up. At which point, every firm you look at with any of that debt, you can work out when they'll go bust because they won't be able to raise that money. And all of a sudden, if you did that today, that's nearly everyone. So the UK government, the US government. So if you're holding a lot of these bonds, as everyone has to, that's a big one. Whereas this, the money is held separately. So if in the event Allianz, if you did this for Allianz went bust, then you get your money back as long as the claims weren't too high. It's all triggered by the claims, not by the balance sheet of the underlying. Regulators have pushed insurers to disclose detailed portfolio information, allowing regulators to pay more of the risks. So there's a lot more information available. We've already had the exercise of not only a company's got curves, but they've got underlying data that justifies that curve. And hence we can do our modelling very quickly and easily, as can others, and also rating agencies and regulators can as well. Rating agencies doubly important. They've got to give the underlying company a rating if they are rated. So it's positive if you put a structure in place, or sell a legacy book, do they get benefit for it? But in addition, if you can get them, it's only investment grade, the rating agencies rate them, they rate them treble B or higher. So if you get it simple enough to fit one of their structures, but they understand these models now, they've been involved in them, they've had to make a judgment on the fundamental side when they rate Allianz and General. So for the insurer, basically their long-term capital is another lever to pull. There is always a risk that in the future the lever may not be there, but the more levers you've got, the better. If you're only dependent on the equity market and you need to raise more equity, that can be a disaster. If you're only dependent on Berkshire Hathaway to provide a quota share just when you need it, you're going to find that's very expensive. If you just rely on it. So the more levers you've got, the more you can look when the market's open. I'd say a very good example for that is for a run-off company or insurance. If the regulator comes along and says you need to hold a lot more money, you cannot go to the equity markets with the story of I need to, you know my business, you've invested in it, I need 100 million from you. The regulator says I need another 100 million. So my business model is less attractive than it was yesterday before in your view because it's got more capital, so the return on equity is less. You're asking me to double up on my bet. Basically you need a different story than that for the equity market. Again, the bondholders on this wouldn't care. As long as they've got 1% chance of being hit, they don't mind putting the money up. Just keep the underlying business is less profitable. That's the first loss there. They're only looking at probability of points. So they would be delighted to take this, whereas the equity markets wouldn't. There are other circumstances that would be great for the equity markets and not into the bond markets, but you give yourself more choices. New tool for insurance capital markets, as mentioned, top line is unchanged, although net written premium isn't. In fact, it's less of a concern for the run-off industry, obviously. And then increased ROE. And basically, because you keep the lower loss layer and you issue the bonds, the only cost you've got is the cost of the coupon and the cost of the transaction in terms of the expenses of it. Everything else can be kept and taken back to the run-off manager or company. The investors love it. The yield, and we thought they would be very interested in diversification and everything else, but yield is basically it. You show them enough yield that they'll be like, yeah, okay, we'll talk about the other bits next time. Is this really right? Can we get this yield? They also, I think, understand that if this could be 5 or 6 times bigger than the current IRLA property cap. Because really that's become saturated. So really there isn't many more issuance coming to the market on property cap because it works very well for the East Coast America because there are a lot of hurricanes hit the East Coast America. And there are a few other places, but it's got to be quite a lot. Otherwise, there isn't enough coupon. So if you do earthquakes across most of America, there aren't enough of the earthquakes. So people only, if the probability is 1 in 500 or something, then how much coupon are you willing to pay? How much premium people pay for the insurance? So there's been a limited market. So people have been desperate to invest, but there's limited opportunities. So they've already maybe committed 0.5%, 1% of the pension fund to this type of market, and they've probably only got 0.2. So they're looking to fill it up. So highlighting that the partners are, we say Brian and myself from PwC, and there's a guy from Lloyd's, JP Morgan, and a couple of other guys. And we use Guy Carpenter, MSC, and S&P and Moody's as the rating agencies. How are people interested in these sort of cash flow bits? Yeah, a few nods, very good. Okay, so this is all ILS tends to work on this structure. So this is a bit more of a legal structure. So this is the insurer. And basically they see premiums in the quota share and they get the reinsurance claims back. And it's a segregated asset cell that only has one contract that does these premiums. It sits separately in Bermuda. There's a trust agreement that feeds in the reinsurance recoveries, so it holds the money in trust. So that's often a charity owns that or something, so it can't be got at in terms of the money, but there's very clear trigger points that they pay the money. So it just kind of sits there as a trust account, a bit like a bank account. And then the investors, they pay the proceeds, so 100 million, they would pay up 100 million, and they would receive their coupon every year or every quarter. Let's say it's 2.5%, they get 100 million, they get 2.5 million each year. And then you could split out the first loss there if you wanted to. It could be the insurer, but in a similar way they get the underwriting return and they pay the first loss layer proceedings. Basically, the first loss layer would issue notes often back to the underlying insurer, so they're losing some capital they're putting up, some cash, but actually they get the capital back via notes that they're holding in the first loss of their bonds. And then these notes are sold on, by an investment bank to the capital markets that would do investment.
James, I was going to save this till the end, but I think it's a good time to ask the question. I mean, so when you're contacted, I mean, what's just the time span for putting this kind of arrangement in place, including getting all the notes away and things?
So 3 months. 3 months if everything is smooth at the company. So the company is quite entrepreneurial. I think Sure is quite entrepreneurial and can move fairly quickly because we can move quite quickly. 3 months for the first. They're done much quicker. Where they're doing the triple X and the property cat. They've done an awful lot of them, so it'll get quicker. But currently 3 months, which probably means in a transaction environment, you'd have to get, say, a reinsurer might pick it up. You might get someone that we would team up with, and we have spoken to someone about that, where the reinsurer would pick it up, and then we put it that most of the reinsurance risk would be taken away. And this may be that the reinsurers would also pick up post 5 years, so basically they can get rid of a lot of their risk to the capital markets and keeping some of it. So it tightens the reinsurance price, but it still works in that. Does that make sense? Because that's a sort of key. It's in some ways it's simple, but in some ways it seems quite complicated. But really, it's all about taking the portfolio and converting it to something that investors find very easy to deal with. And I can't emphasise that enough. In that these guys that do the fixed income, it's a motorway. I mean, their reporting requirements. If you go onto your pension and have a look at it, it'll tell you every 10 minutes what your portfolio is. So their reporting requirements used to be every quarter or something, and then coming daily, and now it's practically almost every minute. But so it isn't fed through, typically Bloomberg or one of the data providers. There isn't a system to flow it through. It becomes a bit of grit in this colossal industry, and they don't want any grit. It's just not worth their hassle. So making it exactly right. So you can put complicated structures in, you can have clever ways of doing it, but they've just got to see a bog standard investment grade product, just so it flows through and the reporting and everything else. It just works in their complicated IT systems.
Obviously with a typical cat bond, it's very black and white. You get the end of the period, and then the cash can go back out once it's clear of the risk or the event and that. Here you get the end of 5 years. It may just be, maybe it was triple B day one. There's been a bit of deterioration, and effectively it's that cash is back in something that's now, say, a double B risk. How does, presumably the regulator doesn't let that cash go at that point in time. So, I suppose I'm just thinking, is that cash is sitting above the sort of regulatory minimum on day one, or is it sitting more within the regulatory capital, the minimum capital requirement?
A few questions there, so maybe I'll start at the end. Typically it sits around that regulatory capital, so it's the top end of the regulatory capital.
Yeah.
Actually, we tend to go top end of the total capital, so no one wants to hold the regulatory capital because that's a too scary place to be, and you're going to get a bit unlucky. So typically we sit, that's the end we sit, so it isn't hit very often. We then have we devised probably a core bit of our technology is to be able to get a closure, a firm closure at the end of 5 years. And we do that basically the accounting number enables us to do that. So 99% of the time, the money's returned straight away. Doesn't matter if it's casualty or anything else, it's just returned because the contract's closed and no longer applies.
Without any refinance required?
So the underlying company needs to have a capital solution to that, as they would if it was subordinated debt or if they've got to pay a dividend on that.
That's not your problem, it's the company's. Yeah.
That's right, and so there'd have to be a solution with the company, perhaps with their reinsurers or other, that they can come up with to do it, but that goes back to the insurance model.
James, is that a fixed commutation clause in the reinsurance agreement from insurer to barrier re?
That's massively oversimplifying it, but fundamentally, yes, it's a commutation. So you look at the accounts. There's not enough to hit our 1 in 200. There's not enough claims, so they can never claim it again. There's a system, so if it's not in the accounts, they can never claim it, whatever happens. And then, so commutation for nothing. Yeah. The reinsurance is worthless because the limit is such that it never be claimed on at the higher levels. First loss layer goes back, all the money goes back. The investors get their capital. I think the system's wound up. No permission by regulators because it's a quota share, reinsurance quota share. No permission. This capital doesn't go anywhere near the balance sheet of the insurer.
Yeah.
So they can't ring fence it, they can't hold it, they can't. So as you're highlighting, there is disadvantages to this structure compared to some others, but if you can work around that and put things in place. So we have spoken, I won't give you too deep, is some of the innovation, is the run-off industry. That legacy bit after 5 years, that is something that we think there could be a different fund. That might be, because you might be able to get paid a reasonable amount of money today to take on the legacy on this in 5 years, or an option to take it on, or, you see what I mean? That would be a natural place for the run-off industry to play, and potentially quite large amounts for that. And if we have people that are interested in doing that, but currently we're keeping it simple in this example. Any other questions? Please. Good questions. Not uncertain questions at all. Any questions? Okay, so how does it enhance return on capital? So we're looking at typically doing 20% of the portfolio, just almost in terms of because your size and to start with. I think you could extend it more. And the banks currently do that on mortgages. They package it up that the requirement that they need to keep 5%. So they're allowed to get rid of 95%. But you getting rid of all of it is viewed as a bit bad post. Well, you should read The Big Short if you want to understand that industry. But so even with just taking 20%, you can typically return. When we've done it, it's between 1 and 3% return, which is very difficult to get. You have to sack a lot of your staff, and then the consequences of that, if you're trying to get that elsewhere, if investors are insisting on a higher return that you can make. So we typically see this slotting in the different ways of improving return on capital, hopefully including selling the legacy business and putting one of these structures in place. And so we're hoping for big enough legacy portfolios that would work with ILS as well. And then we're trying to use the established reinsurance mechanisms and establish where ILS is able to put the things in place. We're trying to use them already. The investors have got comfortable, everyone's got comfortable with them. So we're trying to take technology from a few different areas and plug it together. So really, it's a bit like a sidecar. It's a bit like a property cat ILS. You know, it's a bit like a mortgage portfolio that's been backed up. And by plugging those bits together, the technology is making sure that works. Yeah. No comment. So that's us. Any further questions? I can talk a bit more if you wanted to go through how it might work on a example, made up example transaction, if that's helpful.
I think that would be great. Yeah.
What would be the minimum size? Because the issue of capital markets or the banking is that you mainly have to utilize a large amount to make it worthwhile. So benchmark 50 million for the tier 2 issue, blah blah blah. And of course, there's some legacy players I think are you do that, some perhaps aren't. Where do you think the minimum is?
No, that's a great question. So typically the property cat, they've done a lot of it, and it would have been 50 million, and it's now gone light, and it's now about 10, 20 million, which is really quite low. But for this one, which is new, we say 100 million. So you're actually spot on. It's not 100 million, you're just not going to generate enough interest by investors, because they want to put quite a large amount of it. And of course, that's just the top layer. So that puts it as a deal. The whole capital has got to be closer to 300 million. So that removes a lot of the smaller deals. It may come to that. It may come to the smaller deals in the future, but that's what we currently think will be the right amount.
Do you perceive yourselves as competitors to some of the companies that acquire legacy portfolios? In the sense that you're offering a different solution to companies which you offload the legacy portfolios. So are you competing with the Styles and Cashby?
Yes, just in case anyone didn't hear that, and to re-emphasise the point, are we competing with any legacy? And it's absolutely no. You know, this is a company. It's quite tricky. When we take all the complexity and we keep it simple to ensure they get a reinsurance portfolio, they get a reinsurance quota share, the investors get stuck in this box standard. We do all the clever stuff in the middle. That's quite a lot of clever stuff, and that's where we're focused. So we are basically, we believe in insurers and legacy companies. We are just about revving up their business. So other people, and I think that's the future. I don't think there's talk about ILS taking over the market, and I just, why should it? The insurance as you know for your day job, it's not just all about capital. And ILS only really does the capital side of it. So that is not, people aren't just looking for one solution. However, what you've seen in the property cat space is if you're in the property cat space, some people said this word, this won't take off, ILS won't take off. No one says that now. You basically, if you're in this space, you play in all three areas. You play in the reinsurance, you play in ILS, and you do sidecars. Why wouldn't you look at the whole technology? So anyone who didn't, basically was having their books shrunk, and so they'll begin to offer it. So that's the future. The run-up portfolio, the skill in knowing what's a good portfolio, what isn't, being able to transact quickly, to make the whole thing work, to commute, all the other huge skills that are required. I don't know how many breakfast briefings, the technology, the knowledge is enormous, and this is a tiny sliver of it. So ours is about revving up current players. And indeed, we have no appetite, zero appetite to do any of these transactions. Even in Brian's wildest entrepreneurial moments, he wouldn't go anywhere near that. And you can see why, can't you? Because this is our area. And I think that has been what mentioned about the internet companies. So I was lucky to be in the .com bubble, in the 2000s when it was a massive bubble where you basically got your £100 every time someone visited your site on a valuation, which was just nuts. And I actually had a company with websites as to what the internet was. So it was fascinating times. But there was lots of hoovering out there, a huge amount of, wow, this is going to be fabulous and everything's going to change. And basically, you typically always see it gets added to almost, doesn't it? It doesn't remove, the internet did not remove large numbers of companies, one or two perhaps, but mostly it just got incorporated like the phone to most people's businesses. We'd say ILS on the capital side, we would see it as becoming, for the bigger players, like they talk about the reinsurance arrangements or they put in place.
Do you think ILS investors will still be keen if there's some massive windstorm or hurricane event, and has it been tested enough yet?
Yeah, so I thought there was too much money in the insurance industry, but I'm there to say that the wall of money is so absolutely huge. So they say it hasn't been tested. The investors don't always get their money back, even investment grade. So I think someone has said, the hedge fund industry is still trillions. It's been proven statistically that it does no better than most other strategies that you could do it for a lot smaller cost, and yet investors are still backing hedge funds today, and they've lost quite a lot. So they do not like it if there is a hurricane or anything else, fine. They do not like it, and you wouldn't if you were an investor. Typically, it's not their own money, and they're one part of a big company. If they said invest in this, and then after a short period of time, they don't get the money back for something that they hadn't considered, or a risk they haven't looked at, then it's going to be that's a big term. That is, we don't understand this. We've been ripped off. That will be. But the property cat, etc. London, there's hardly been any that's ever been hit. And the idea that one's hit, I think there's a pool of money that will come pouring in, thinking that the yields will go up.
My understanding is that a portion of this capital becomes more significant over 5 years because less capital is required and therefore other capital increases as a company recapitalizes. What happens if they're extreme currency?
So you're saying in a run-off reserve adverse development cover, how that strengths, how do you allow for currency? Currency is very complicated. I just thought currency was relatively complicated, but the more I get closer to it, the more complicated it is. So you can't hedge everything. You can hedge best estimate your extreme view. So typically the issuance, they want the issuance to be in one currency. So that's you're typically running it like you would if you're a quoted company and you quoted dollars, and then you're running that currency. So you have to manipulate that.
Just on LOCs, there have been times in the Lloyd's market, for example, where you had to go back and ask for more capital. I just wondered in this situation, did you ever come across that?
Well, we haven't come across the majority has always been in one currency, but we have a few of the early transactions that we've talked to people that if it's big enough. So that you can put the hedge in wherever you like on the system, but some hedge are either stage with the company and it's part of their hedge mechanism. So they might get some, but it's a quota share arrangement. So it's basically the same problem you got on any quota share arrangement. How do you deal with currency? And there's some standard ways. You kind of put fixed currency in there, and different currency, or you can do some variable and you do some adjustment mechanism. So you could do it with it. You could just do it standard, but you could allow for whatever the currency is, and it converts. So you'd all have dollars, but in the event that you're getting an awful lot more claims, you might have to increase your first loss layer so that you may be collecting a little bit later, and that might keep the probability. And long answer to that is you have to look at the portfolio. What is the currency risk? How are you going to deal with it? And then you try and put something in place. But unless it was colossal, you'd only be issuing in one currency.
Great. Any more questions for James? James, that was absolutely fantastic. I thought your passion for this just came shining through in that presentation. It was a great way to spend an hour on a Friday morning. I think, as you said, the runoff industry is well known for innovation. I can see how this, be very much complementary to that going forward. So, if we'd all like to say thank you. I wish you all a brilliant Friday and a good weekend. Very quick plug, couple of upcoming IRLA events. One in Paris, our free continental event on the 8th of November. And no doubt see lots of you at the annual dinner on the 17th of November. Have a good day. Thank you.